Good evening, everybody. Financial statement analysis is our topic tonight. Capital risk and return was our topic last week. And case study number 1 is your first case study work in this course. It has been posted to Blackboard under the case study file folders. And it's quite a handful, I must admit. It's going to keep you busy in the next week. I'll go over that a little bit later after our 7 o'clock break. The good thing about it is it's due on a week from today, basically October 20th, Tuesday. But we have no graded work next week scheduled. So if you want to take a couple extra days doing that case work, you're more than welcome to take advantage of that. I don't know what side of the bed I got out of, but when I started putting together this case study for this class, I'm keeping you busy with right off the bat with this study, but it's a good one. You'll learn a lot. So we'll talk about that a little bit later. So last week we talked about present value, risk and return, looking into the future for determining what value is being produced by those future returns in the present value of today. I had you do a little discussion forum giving an example of those last week, and I had a chance to read through them today. Very well done. I especially like the ones that involve real estate and stocks, a little bit more complicated calculations or scenarios. I appreciated that. And also I appreciated everybody's responding to your fellow classmates. I thought that was very good. Granted, I'm not going to sound like an ogre. I could have looked for a little bit more analysis or commentary, but all in all, it was very good. And I posted the grades for that work already to your Blackboard. So right now you have 10% of your course grade determined, and the cumulative average is in the front page of your Blackboard site. This week we're going to add another 15% to that cumulative grade with case study number 1. And again, as I said, we'll get into that a little bit later. One of the things about determining, looking at real world present values or real world future values is sometimes there's different ways of interpreting them. One student, one investor, one professor might think of interpreting a present or future value analysis one way, and another student, professor, colleague would interpret it another way. But in the case of many of the future and present value calculations, it's pretty well straightforward. What's the dollar amount, the principal? What's the interest rate per period that we're talking about? And what is the amount of time? How many periods are being discussed? For example, if I have a 2% annual interest rate compounded semi-annually, that means the interest rate will be 1% per period, and there's 2 periods in a year. Sometimes we miss those things in our calculations, but it's just practice. It just takes time to get used to. I have a savings account through Wells Fargo Bank. The interest rate is compounded daily, like many savings accounts. Wells Fargo and many banks think they're giving us a huge windfall by the interest rates being compounded daily. Well, if the interest rate per year is 0.5%, 0.5% divided by 365 days is a year, we're not talking a huge amount of interest being paid on that savings account. So thank you very much, Wells Fargo, for giving me 2 cents a month on my savings account. But in the long term of things, I mean, it's not that big of a deal. But again, you have to make sure when you're looking at present and future value, and we'll be seeing a lot of this in the upcoming weeks, not in case 1, but in upcoming cases, We have to make sure what's the principal, what's the interest rate involved over how many periods. And that's an important factor. And let's take a look at a couple other things in that regard. When we talked a bit last week about the risk and return and the present and future value of bonds, stocks, present future value of number calculations. One of the things that we talked about, and this is a topic in your case, and I'm going over it again tonight as a prelude to our other lecture, but in your case, you're going to be asked to do a capital asset risk analysis of a company in the case number 1. You're going to do 2 things. Matter of fact, you're going to do a financial statement analysis, and that's the topic of our lecture tonight. But also you're going to do a credit analysis of a company. I give you a list of companies, you pick one, and you're going to do a credit analysis. Well, what's a credit analysis? You got to look up its credit rating. They're somewhat resembling a FICO score for us, but you look up the S&P Standard & Poor's credit rating, or the Moody's credit rating, or the Fitch's credit rating. Those are the 3 companies that take the credit ratings of corporations: Standard & Poor's, Moody's, and Fitch. And also you're going to be doing a cost of equity analysis using the capital asset pricing model. And remember, we did this last week. When a company has a beta of 0.8, remember, betas can run from a 0 beta which is the United States Treasury yield, more commonly known as the 10-year United States Treasury yield. But again, somebody's interpretation of that might be a little bit, okay, it's the US Treasury, not the S Treasury. Off to a little bit slow start typing tonight. In an institution that has a beta of 1.0 beta, that's the stock market. The stock market, the market beta. That's exampled by the S&P 500 index. That index has a beta of 1, average market risk. And you can look at all, and from there it goes either up or down. Greece, for example, we might have talked about this last week. The government and the country of Greece has a beta of 4.85. Not the best credit. A beta of 4.85 can equate to a FICO score of about 175. But FICO scores don't even go below 250. So you know you're in big trouble if you have a FICO score of 175. It means it's time to start the buses and head out. That's what a 4.75 beta represents. A beta of 0 is like an 850 FICO. No risk whatsoever. Now, not too many people have a FICO of 850, but that's what 0 beta represents. Average beta of 1.0 would be pretty much the average FICO score of adults in the United States. I think I saw the last one as being about 615, 620. Average. Some more, some less. In this company here we looked at last week, and this is referring to chapter 6 in our text, is 0.8 beta. The risk-free rate in the market is 4%, and the average return in the market is 12%. If I wanted to buy stock in AA Corporation, what is my expected return going to be based on the market indicators of 4% at 0 risk, 12% at average risk, and this company with a risk of 0.8, somewhere in between those two? Well, the capital asset pricing model, and we're going to look at a little quick video on this in just a minute, The capital asset pricing model takes that risk-free rate, 4%, and adds it to the difference between the market return and the risk-free rate, 12% minus 4%. That is also called the market premium. And that market premium is multiplied by the risk of that particular company you're trying to determine the expected return, in this case, 0.8. So if I take 8% times 0.8, I get 6.4%. I add the 4% risk-free rate, I get 10.4%. The higher the return, the greater the risk. The higher the return, the greater the chance you might fail. Doesn't mean you're going to fail as far as getting expected returns, but the standard deviation, the probability, whatever word you want to use, increases with failure the higher the return. Because you're rewarded for that bad risk with higher return. So when somebody says, hey, Brianna, I got an investment for you with an expected return of 17%. Some people who don't know this would go, geez, sign me up, 17%, holy moly. But then if Brianna is smart, which she is, she would go, wait a minute, 17% when the average market return is 12%? What the hell is this thing? Oh, it's an investment in a methamphetamine lab up in the city of Claremont. Well, okay, I'm not going to do that. High risk. It's illegal. And the return is high, but I don't think I want to be investing in that type of stuff. But if somebody says to Brianna, hey, I got an investment for you that can pay 6% return in the next year. Well, Brianna might also say, what's up with that? 6%? I can just invest in the S&P 500 right now and get 12%. Why do I want to invest in 6%? Well, the salesperson or the broker or the investor who's trying to sell you this investment is saying, well, it's a lot safer. And Brianna goes, yeah, but it's too safe. I want to make a little money here. But that's exactly what risk and return is. The lower the risk, the less return. The greater the risk, the more return. But it's a gamble. All right. And this is what it means in chapter 6 by risk and return. Well, you're going to be doing this analysis for a real world company in your case number 1. You're going to determine its cost of equity under the capital asset pricing model. And you're going to determine what that tells you about the risk of that particular company. And it all is driven by the company's beta, which you will look up and then fitted to this equation and make that calculation. But then the key to the case is anybody can do arithmetic. I want you to interpret what it means to you as an analyst of the credit of that particular company. That's the key. David Liu, question, sir.
So in your opinion, or I guess in your opinion, what's the nice margin of error between that market risk for expected return and the risk of return?
David, I'm going to be very political here, like I'm Donald Trump or Joe Biden in a debate. I'm going to answer that the most logical way possible. And it's my opinion too. It depends on your individual aversion to risk aversion. Brianna might want to take the 17% return on that Met Lab in Claremont. Sorry, that's a bad example, but it's the first thing that popped in my head. I don't know why Met Lab. Good God. But Brianna might be say, you know what? I'm young. I can afford it a little risk here. I'm going to grab it. But if I ask Mr. Hasse about investing in that 17% risk, I'm going to say, hell no. I'm 60 years old. What the hell do I need in getting 17% return? I've made all my money already in my life. I don't want to lose it. So I'm going to go with the 6%. Matter of fact, right now, I'll be perfectly honest with you, 85% of my investments are in the risk-free interest rate category. I'm making about 2%, 1% a year. Why? I don't want to lose it. I don't care about inflation. Hell, I'm going to die in 5 years. What do I care about inflation? I don't want to lose my principal. So I'm really risk aversion. I'm not going to get into anything. But Brianna, and Brianna, sorry for picking on you. Brianna, because I can see you, that's why I'm picking on you. But Brianna is young. She can take a little risk because even if she fails or loses money, she's got 40 more years of making money and making that back. At 60 years old, I don't want to risk any more money. I've already made my money for 40 years. I don't want to lose it. So, David, to answer your question, a lot has to depend on you, the individual investor, about your aversion to risk. Now, forget that side of the analysis. The general rule of thumb in the market is to go after the expected return, the beta of 1. You build a portfolio averaging a beta of 1. You got a little risk in some stocks, a little risk, no risk in other stocks, or in fixed income bonds, and you combine them all, and the average is 1. Now, if I was 25 years old, I wouldn't do that. I would go for an average of beta of 1.5. I can afford to be a little risky and make a little bit more money. But if I was 60 years old with the old cougars, I'd be in the beta of the 0.5 and lower realm. So, David, it depends on your age. It depends on how much money you got. If you got a lot of money, you can afford to lose it, a little bit of it, not all of it. But if you don't have much money, you got to hang on to that and hang on to it tight so you don't want to do anything stupid. Did I answer your question, David?
Yes, sir.
Thank you, sir. It's just like in looking at some of your discussion forum posts of the past week. Some of you liked real estate. Some of you like stocks. Some of you savings account at the credit union. Good Lord. Some of you were a little bit more aggressive. Everybody has their individual risk aversion. And that's one of the things when a stockbroker or a 401k manager or a pension fund manager sits down with you and says, okay, David, what do you want for a return? Some people might say, give me 15%. I don't care about the risk. Go for it. Other people say, listen, you son of a gun, if you lose $1 of my principal, I'm going to come after you. So invest it with zero or low risk. It depends on the person. It depends on the person. And where a lot of us do, what's our biggest risk in our life in investments? Real estate, buying a house. Is the property going to go up in value in a time period that we can pull out of it? Or are we just going to stay there and live there for 35 years and we could care less? That's our biggest risk aversion. 401ks are designed to just burn them and churn them. 401ks are designed for minimal risk and just protect your principal. You're not going to make much money in a 401k unless it's all in stocks. Well, it depends on how you allocate the money. So that's this week's investment tip, and it's coming from somebody who's been very general in his answers, but I don't want to tell a student like Brianna, oh yeah, Brianna, go ahead, invest in 17%. And then 2 years later, she sends me a little email, hey, Mr. Hasse, I lost all my money. Thanks a lot. So you got to be careful. Or I tell Preston, hey, Preston, why don't you just buy treasuries and make 2% a year? And then 2 years later, he calls me, he emails and says, thanks a lot, Mr. Hasse. All my homeboys have been making 10% a year, and I'm sitting here not even keeping up with inflation. Thanks a lot, Mr. Hasse. So again, it's an individual thing and an individual knowledge of what you can make. That's a great question, David, so thank you. So now on that subject of return and expected return, let's take a look at a short video from our playlist for this class. It's only a couple minutes.
In this video, I want to introduce you to the capital asset pricing model, which is often called CAPM for short. So CAPM is a formula that's used to calculate the expected return of a security given its level of systematic risk. So here's our formula, and the expected return of a security, so let's say security I, so we've got R sub I, so the return of security I is equal to the risk-free rate of return. That's the rate of return you would earn on an investment that has zero risk. For example, you might say a 3-month US Treasury bill. Let's say the rate of return on that was 1.25%. Then that would be your risk-free rate. And then you add to that the beta of security I. So I've got beta sub I. So the beta is a measure of the systematic risk of this security. Okay, basically how much is this security, how the value of that security, how much is that tied to the overall market performance? Okay, so we've got this measure of systematic risk beta, and then we multiply that by this whole thing right here, which is the market risk premium. The market risk premium is the expected return of the market. Okay, so let's say our market portfolio is the S&P 500. The expected return of the market minus the risk-free rate. Okay, so when we take the market return, the expected market return minus the risk-free rate, that's the market risk premium. Okay, so when we take the market risk premium, we multiply it by the beta of that security, and then we add the risk-free rate. That's going to tell us the expected return of security I. So this whole thing is the capital asset pricing model, and I'm just laying out the different components. By the way, so you'll sometimes hear when somebody's talking about a stock, if someone's talking about the stock in Microsoft or Caterpillar or some company, you might hear them talk about the cost of equity capital. And that is the same as this thing right here. So this expected return of security I, this return is basically the return that investors expect to receive given the level of risk that they are bearing. How much risk are they bearing? Well, that's what beta tells us. And so when we say what is the cost of equity capital for Caterpillar shareholders, and we're thinking about stock in Caterpillar, let's say it was 9.21%. That's what it's telling us right here. That's the expected return in Caterpillar stock that someone would be expecting. And so we'd say that's the cost of equity capital. Now, I'm going to make some more videos on CAPM, but one thing I really want you to note is that an implication here of the capital asset pricing model is that the more systematic risk that the security has, going to be the higher return that the investors are expecting. So here's our measure of systematic risk, that's beta. If beta, let's say that beta was 1.25, so if beta was 1.25, and then we were to increase it where we said, you know what, instead of it being 1.25, it's 2.5, or it's, let's say it's 3.0. So the higher we make this beta, the higher is going to be the expected return of the security. And if you think about it, that makes sense. If you are an investor and I tell you, look, it's actually this investment is riskier. It's instead of the risk being 1.25, it's 3 or it's 4 or something like that. The more risky the security is, which is measured here by beta, the more risky the security is, the higher the return you are going to want to receive, because you are wanting, as an investor, to be compensated for bearing that risk. And here, with the capital asset pricing model, we're assuming just that there's a single factor. People later went and added additional factors and said it's actually more. And we'll talk about multi-factor models in the future. But for right now, this is a single factor model. We're really just looking at this market risk premium times the amount of systematic risk, and then we add that to the risk-free rate, and that is telling us the return that the investors in that security expect to receive given these factors.
Okay, that's what's talked about in chapter 6 and 7, and I'm spending a little bit of time on it tonight because to refresh yourself, and this video is in our YouTube playlist in case you see that, hint, hint, in case number 1, you can refer to that in case number 1. Now, what do I mean by beta? Well, we might have done, you all might have done this before, but if I go to Yahoo Finance, which is kind of like a generic browser to look up financial stuff. If I go to Yahoo Finance, and let's say I'm thinking about investing in Ford Motor Company. So I'd go up here to search and I type in Ford, and up comes everything you wanted to know about Ford. Oops, sorry, it took the wrong thing. Let's do that one more time. Ford Motor, there it is. And now up comes everything I wanted to know about Ford. And the stock today closed at $7.57. In other words, lately, Ford is a dog with fleas. And that's a good expression for Ford lately, a dog with fleas. Go ahead and buy it, but the smell and the fleas are going to stick with you for a while. And how is that shown? Look at their beta. Look at Ford's beta, 1.31. Ooh, yee. So if I want to buy Ford stock, I expect a high return because this is a dog with fleas. Look at their earnings per share is negative 54 cents a share. All right. They're not doing so hot. Now they anticipate their stock going up. The market says, oh, it's at 757 within a year, $7.90. Wow, I can make 40 cents? I should think about something else. But this is what we're referring to. You can go to the market indicators like Yahoo Finance, Google Finance, go to D&B Hoover's database we mentioned in the Wilson Library, and the beta will give you that risk, that credit risk of any company that's publicly traded. And you're going to have to look that up for a company in your case study this coming week. And we'll take a look at that in a few minutes. But I wanted to go over that. Capital asset pricing model, the risk and return strategy concept, and how you measure that systematic risk, as the professor just said in the video that kind of mirrored what I was saying, maybe a little bit better. The beta is 1.31. And again, this is a systematic statistical standard deviation regression analysis comparing Ford's return over the last 5 years to the market. And Ford hasn't done as well. The deviation is greater, thus the higher beta. Remember from your days in statistics? Wasn't that exciting? Standard deviation is the higher the deviation, the greater the spread of outcomes. That means the greater the risk because it's not compacted in a small amount where you can know where everything is. A greater deviation means a greater risk, a greater chance for something either going great or also going wrong. And that's what beta represents. Okay, so let's get out of this for now. And now let's get back to our topic at hand this evening. And first of all, before we get into some spreadsheets and some look-sees, let me bring up our Blackboard account. Not account, file folder. All right, here it is. Matter of fact, Mr. Patel gave a guesstimate on what this is here. And Mr. Patel, you are incorrect. You are incorrect in what you told me there. You're in, it's in the state of California. You got that right, but wrong area of the state, I must say. Wrong area of the state. That's a little another hint.
Hey,
All
Mr.
right.
Nassi,
Yes, sir.
you can't do a class of solid and give us like maybe one clue, because that's a tough one. There's no skyscrapers. There's nothing.
Well, this is kind of going over a couple of weeks, so I'm just gonna say, if you can, no, I'm not gonna say that. That's too much of a clue. There are clues there, buddy. There are clues there. Now, it doesn't have to necessarily be the skyline, and you're not gonna get a clue by looking at the coffee cup. Yeah. Okay, so there's other clues there, just so you know. But Mr. Patel gave a pretty darn good guess. I was very impressed by that, but not quite. So continue on in your quest for extra credit points. Sorry, Walt. Now, next week, maybe I'll give you something a little bit more. Matter
How
of fact,
about how about a higher resolution picture, Professor?
well, now, again, let's not get greedy here. Let's I
Ooh,
gotta
I
make
like
this.
that. I like that.
All right, let me think about that. Now, remember, no, okay. Well, let's move it on for that. I'll see what I can do about that, Carlos. So see what get a little higher resolution. That's a good thing. Maybe I'll put that up next week. Okay. Jeez, you guys. Figure, come on. I gotta make it a little challenging. All right. Now, first of all, a couple things to look in your Blackboard for this evening. Go to week number 3 in the in-class review file folder. There's a couple files. If you can download these and follow along with me tonight, that's fine. If not, note them for later. The in-class review spreadsheet, which we're going to take a look at a financial statement of a company, do a little refresher on what financials are for finance people, not the bean counters. We're not accountants, we're financial managers. So we're going to take a look at those, that spreadsheet there, and then a little financial statement analysis interpretation, which will come in handy in your case number 1 work, taking a page out of your textbook, which I know, and I already told you, the textbooks are optional for this class, but I went ahead and did a little PDF file picture of a page in your textbook, and that's going to be very handy for many of you in the upcoming week. So we'll take a look at those 2 files in just a minute. Okay. And then secondly, there's now a file folder called case study. And there's 2 files there. Both are the same material. One is in a PDF format and one is in a Word doc format. You can download either file of your choosing and begin the work. Now, after our dinner break, or a 7 o'clock break, not dinner break, I'll go over this assignment because some of you are going to read it the first time and go, what the fruit is all this? Help. All right. But I'm going to push a few buttons on this case. I'm going to see what we got in this class, and I'm going to find out rather quickly. So I'll explain what's going on there, what I'm expecting of you, and see if you can give it a good whirl. So this is your casework. This is where you'll post your file and your casework when you're done. Now you can use any format of giving me your answers that you find. You can use a Word file right from the, just right on the document I gave you. You probably won't have enough room or enough leeway, but you can do it that way. You can to write out something in a Word file and then give me an Excel file with some of your calculations or analysis, the calculation analysis. You can give me the 2 files. You can give me 1 file. You are the determinant of how you present this. That's part of the assessment. How is the student going to interpret the data, calculate the data, and give me their analysis of the material at hand? So don't anybody freak out yet by looking at it while I'm talking about other things, but we'll go over this after the 7 o'clock hour. So that's our first casework. Remember, we have 4 of these during the course of our class. Case number 1 is financial and capital analysis. Okay. Higher density picture. Give me a break. Okay. Here's the class 3 spreadsheet. And again, some of this might be a little boring for some of you, especially the accountants or the numbers people in the audience. But other people are going to sit here and go, thank God, Mr. Hasse, you showed me this. It's been 10 years since I looked at an accounting financial statement or studied accounting. Thank you for doing this. So either way, this is a good refresher because you're going to be doing an analysis about a company's finances in case number 1. First of all, what are financial statements? Well, financial statements are statements of revenue, expense, income statement. Financial statements are a statement of a company's value, net worth, assets, liabilities, and equity, a balance sheet. Financial statements are interpretations of the cash flow of the company. Cash flow from operations, cash flow from financing, cash flow from investing. The cash flow statement tells us about where is the money, the capital, the cash coming in, and where is it going out for this business. Very important statement. For example, look at the balance sheet here. Notice the delta from 2018 to 2019 in their cash and equivalents is $6,718. The cash flow statement tells us where that $6,718 went and came in. Profits, working capital changes, payments of debt, the issuance of stock, the paying of dividends, money going out in short-term investments, money going out to purchase fixed assets or property, plant, and equipment. It gives us a snapshot for a year of how money, cash, capital, euros, pesos, ruples came in and out of a company. And all this information, if you follow the color code, came from the financial statements, the balance sheet, and the income statement. All of these flow into the cash flow statement. That's why the cash flow statement, especially for finance managers, is a very nifty little tool because it tells you about the efficiency of managing cash in this particular management structure of this company. This is a real world company based in San Dimas, California. I won't give you the particulars, but I happen to play golf with the owners of this company or the management team of this company. And the stock is publicly owned, very small issues of stock, but it's a business in San Dimas that, yeah, I'll go ahead and say this because I tell it to these guys all the time on the golf course. This is another company that's a dog with fleas. A dog with fleas, and we'll explain why in just a minute. And the areas that we look at are the cash flow statement, financial analysis, the trends being shown by key ratios. Page 120 of your textbook, if any of you do have a textbook, but don't worry about it. I copied a picture of that to show you. And the expectations of future capital needs, this is chapter 12, called the AFN model, additional funds needed. Now, this is not going to be on case number 1, and we're going to cover this topic next week. We're going to do this next week, AFN, chapter 12. This week, we're going to concentrate on this stuff because this is our case number 1 work that we're doing this coming week. So don't worry about AFN model until next week, and we'll go over that very closely because this is a very nifty little piece of calculation. It tells us what we can expect of capital needs going forward based on our prior ways of doing things or trends in this company. A lot of times when I look at a possible investment in a company, I look at their 3 financial statements. I concentrate on their cash flow statement to give me the efficiency, the profitability, the debt position, all that sort of thing. And then I take a look at what, in order for them to make money, where if they anticipate wanting to grow at 9% next year, where are they going to get the capital to fund that 9% growth? Is it going to come from their profits? Is it going to come from debt? Is it going to come from the issuance of new equity? Maybe finding a partner, maybe finding a Shark Tank somebody. Because I need to know that and understand that if I'm going to give some money to these people, can I make any money in the future off this? This is what Warren Buffett does all the time. He looks for companies with low value, low stock price, but they have the potential of making a lot of cash, a lot of return. He finds key things in his analysis, and every manager does this. He's just been more successful than anybody because he's one of the richest men in the world. He knows how to do that. A good investor can pick these things out of an investment portfolio or an investment analysis and go forward. You're kind of doing that. Well, you are doing that in case number 1. So the balance sheet is an interesting statement. This company over 2 years has shown the deltas of how the balance sheet has changed from 2018 to 2019. Now there's a couple areas of the balance sheet that are important. First of all, current portions. The current portions of a balance sheet. Current assets, current liabilities. These current portions are also called working capital, cash, receivable, inventory, payables, accruals. Financial entities that have less than a year of life. They turn over quite quickly. How is the working capital being managed by this company? The second area is long-term assets, long-term debt, stock holdings, book value of stock being issued, and also the retained earnings of a company, the profits they're keeping after dividends for possible reinvestment back into the business. So short-term, current, long-term. Short-term tells you about the efficiency of managing their day-to-day working capital. Long-term is where the money is to be made or lost. Because are they investing in new equipment, new buildings? This company is not. They're sacrificing the future to pay back debts today. Not very efficient. But maybe they have no alternative because they're not making that much profit. And also the long-term version tells us about interest-bearing debt. And you can see that by just looking at the income statement. Last year, this company had an interest expense of $176,000 in 2018. It dropped more than half in 2019 to $80,000. Why? They paid off debt. They paid $920,000 off on debt, interest-bearing debt. Bonds and notes payable. Wait a minute, Mr. Hasse. Notes payable is interest-bearing debt. Why is it in current liabilities? Because it's telling the investor or the viewer of this information that this notes payable is due within the next year. All right, it's current. It's interest-bearing, but it's due. That $300,000 is due in the next 12 months. That gives you a heads up. Whereas the bond payable, $500,000, is due, specifically with this company, it's due in 10 years. But they went ahead and paid off some of this debt because these interest expenses were choking them. Notice they lost money in 2018. One of the ways of alleviating that is they got rid of some of that leverage, reducing their interest expense, their fixed cost, and thus made a little bit more money. They knew they had to show profits to attract investors quickly. So they issued stock and mainly took that stock issuance and paid off debt. Not the best strategy, but a strategy nonetheless. And the income statement also tells us that this company pays dividends. They lost $95,000 in 2018, but they still paid 11 cents a share in dividends. How many dividends did they pay? Well, if they have 100,000 shares of stock outstanding in 2018 at 11 cents a share, that means they paid $11,000 in dividends. Even though they lost money, they paid a dividend. David Liu, you have your mic on. Let me ask you, why would a company that loses money pay a dividend to their shareholders? Why do you think?
They don't want to lose all the shareholders because everybody wants their money back.
Exactly right, David. Well done. It's that simple. I want to keep the shareholders from bailing. The last thing I want is shareholders to sell the stock and the stock plummet. My lenders at the bank are going to say, hey, what's the deal, you guys? I might have to call in your loan. No, we don't want that. Keep the stockholders happy so they won't sell, so give them a dividend. We lost money, but we'll pay a dividend. and then reward them in good times. Look at in 2019, they doubled the dividend to 22 cents a share. Plus, they added 150,000 shareholders in the 2019. Now they have 250,000 shareholders because they issued some stock. So they had to pay $55,000 in a dividend. And notice the retained earnings. Back to our old accounting days. Remember when you close the books at the end of an accounting period? You do the closing entries. Ugh. But what are the closing entries? You close all the temporary accounts, income statement accounts. You close them. Why? Because you want to know what your revenue is going to be in 2020, what your expenses are going to be in 2020, what your profits are going to be in 2020. So you zero those out. And in 2019, when they zeroed them out, $253,584 ended up in retained earnings. Wait a minute, Mr. Hasse, the delta in retained earnings between the 2 years is 198,000. Why? I have to close out the dividend account as well. Money going out. So I close out the dividend account also to retained earnings. 253,584 minus 55,000 dividends. There's my delta, 198,584. This is where the income statement meets the balance sheet to be carried forward into subsequent periods. This company, through December 31st, 2019, has accumulated $296,216 in retained earnings, profits less dividends. Now, naturally, in 2018, retained earnings took a big hit. They lost and they still paid a dividend. Retained earnings took a big hit in 2018, but they got some of that back with the profits they made in 19. Take a look, everyone can see something entertaining. Take a look at Tesla's retained earnings balance on their balance sheet. That's quite entertaining when you think Tesla is such a hot stock. Their retained earnings balance is negative $1 billion. That's accumulated losses over the course of the life of the company. $1 billion. So when I have a broker that basically calls me up every week and says, Rick, have you changed your mind on buying Tesla? No, I'm 60 years old. I'm going to die in 10 years. What do I care if it's going to take 15 years for Tesla to start making money? What the hell do I care? Now, if I was 25 years old and 30 years old, I might say, yeah, okay, I can wait 15 to 20 years. Go ahead. I'll buy it.
Is that Professor Hasse? Is that because they keep buying more, more warehouses and more equipment and more?
Well, basically, again, Tesla has a great product. Have you ever driven a Tesla? It's a lovely car. Lovely car. But in order to sell it in the market today, 2020, they have to sell it at a specific price. That price doesn't cover all the expenses of producing the product.
Okay.
If they wanted to sell it and make a profit, they'd have to sell it for about $150,000. Now, how do you alleviate that? You sell a lot of them at $60,000. And they're starting to do that better. And also, they're narrowing their margins by cutting their expenses, by becoming more efficient, having the right employees who know how to make the product, and also the technology is becoming cheaper. Just like Apple. Apple wouldn't be Apple today if they didn't reduce and make it so cheap to build their products. It's cheap. Why? They're made in China, no labor, no taxes. Why? The technology, microchips, the technology is cheaper. That's one thing that is one of the interesting things about my management life is how there's some industries where the products get cheaper over time because of the technology. Amazing. And Tesla's hoping for that too. But they're going to keep, they have a couple of quarters like recently where they make a little profit because they got their volume up. But until they solve that problem of reducing costs and the cost of the technology, and as you said, Preston, the cost of building new plants, the cost of R&D, the cost of developing the technology, the cost every time Elon Musk opens his mouth, it costs the company money. You should just be quiet and run the company. Until that happens, they're going to keep not making much money. But a lot of people buy the stock, and I would too if I was 30 years old, because they anticipate this is a great product. Eventually, the market, their cost structure is going to come in line and they're going to kick ass. And they're right. A lot of people are banking on that. But at my stage in my investment career, I don't have the time. I've run out of time. It's too late for me. Okay. But in my mind, there's other companies to invest in if you're looking at sustainable technology. I think there's other businesses out there that are more attractive, but I'm not going to give my advice here because this is not an investment class. All right. This is looking at the financial statements. But great question, Preston. Okay. So that's where the balance income statement meets the balance sheet. That's how the two join together going on into infinitum. Remember the ongoing concern assumption or principle of accounting means the balance sheet accounts live forever. The income statement accounts are only for a year. And how they merge together is when you close those books into retained earnings by zeroing out revenue, expense, and dividends in the accounting closing process. And many of you have gone through that in your accounting classes. Yeah. Okay. So that's that. But now we're going to talk about, okay, we got everything closed, we got everything in the balance sheet, fine, but what does it tell us about the company? Notice all the deltas here. These are the differences between 2018 and 19. All these deltas. Where are all these deltas? In the cash flow statement. Remember, the bottom line in any company, where is it? By the way, the Dodgers are up by 2 touchdowns tonight. Do you believe that? 2 touchdowns. Good Lord.
Touchdowns.
Yeah, its score is 15-1. They're up by 2 touchdowns. So they're kicking butt tonight. 2 touchdowns. Holy moly. All right, be that as it may.
Some of us had that on delay. Thanks a lot.
Oh, well, Walt, sorry, but you're from Northern California. You're a Giant fan anyway. Who gives a hell?
Oh, no. I'm a Long Beach all day.
Oh, all right. Because I thought you were sniffing. I could tell by the smell I was getting off when you turn on your mic that you're a Giant fan. But I guess I was wrong. That must be some other smell. I'm teasing. All right. But the Dodgers are up by 2 touchdowns, so this game is over. They're in the what inning? 8th inning. You guys can't see it, but I got so many computers in this room, it's enough to kill you. And I got a computer onto the ball game, so I'm kind of glancing at it every now and then. But be that as it may, the bottom line with any company is right here. Cash. Everything eventually is turned to cash. Receivables, inventories, payables, assets. Eventually, it all comes down to, are you generating this? Because if you're not generating that, that's the lifeblood of the company. I'm not going to invest in a company that's cash poor. Are you kidding me? They're cash poor. They're not investing in new growth, new R&D. They're not investing in new marketing strategies. They're not investing in people. One of the reasons why you guys are getting an MBA degree is you're going to make yourself more expensive in the market. That's a good thing for you. And in order for companies to get the value out of that increased expense with an MBA degree, you're going to produce more returns for them. Better decision making, more efficiency. That's why you're doing this. And that's why companies hopefully will pay you more once you have that degree. Now, I know people without MBA degrees, even without business degrees, who are wonderful businessmen and businesswomen. But in the general speaking of the market, you have that degree, you got a heads up, you got a better probability of getting that return. So if I take those deltas between all the balance sheet accounts and organize it by operations, financing, and investing, I can get a nice little picture about the efficiency of this company. Operations, the net income of the company. Adding in depreciation. Wait a minute, Mr. Hasse. If my memory serves me right, depreciation is an expense on the income statement. Why are you adding it in to operations? Simple answer. Am I writing a check to Mr. Depreciation for $120,000? I get to expense fixed assets over time because the tax code, the IRS rules allow me to do that. Why do you think the government allows you to deduct depreciation expense on your tax return? It's encouraging for you to buy more equipment. It's encouraging for you to buy more fixed assets. That's why the government does that, because what is the biggest outlayer of money for corporations? The purchase of buildings, equipment, R&D. That money the government gives you a tax break on by allowing you to deduct the depreciation on those assets. And the thing also is it's generating cash flow. Yes, I made accounting profit 253,584, but I actually made in cash flow profit 373,584. I add back in depreciation because I didn't spend any money. That's why in a lot of your companies, in the fourth quarter of your fiscal year, a lot of people say, all right, have we spent our capital budget? Have we bought any new computers? Have we bought any new technology? Have we bought any automobiles? Have we bought anything? What? We haven't? Let's get going. Our capital budget was for $2 million. Let's spend that money. Why do they want you to spend it? Why? Because you get tax breaks by depreciating it. And you're also increasing the value of the asset base and hopefully that $2 million of additional asset purchases will produce more return. A key. Show me a company that doesn't replenish and update their computer systems. Show me a company that doesn't provide a great work environment in their buildings. Show me a company that doesn't have the most efficient telephone systems or IT systems. I'll show you a company that's going to get passed over in the market. Why? Inefficiency. Why do you hell you think Amazon's kicking butt? They invested in the cloud. They invested in IT. They invested in distribution centers. Now that money is coming back hand over fist because they can outcompete their competitors. They run the show. Because why? They bought assets. And they get a tax break on the buying of those assets. And they're creating greater return for the business. Every major corporation in the world that's successful does that very well. Another thing in operations, these 4 accounts here, these are called operating working capital. Short-term current accounts receivable, inventory, current assets. Short-term current liabilities, accounts payable, and accruals. Now take a look at this. Our accounts receivable went up $245,000. Our inventories went up $429,000. That's $675,000 of increases in working capital operating current assets. And look how it's shown on the cash flow statement. Negative $675,000. That's cash we did not collect from money owed us. That's inventory we did not sell that we produced or bought, and it's sitting on the shelves. No cash came in. Negative cash flow. One of the first things I always looked at when I was helping companies manage their affairs is, did they have an efficient receivable collection operation? Were they collecting their receivables in 30 days, 28 days, 25 days? And if not, why? Were they selling to a bunch of deadbeats? Were they selling to people who just took advantage of them? Well, if so, you got to kick a little butt. Secondly, why do they have so much inventory in stock when they're not selling it? Keep your inventory managed properly. Many of you have heard of Dell computers. I'm speaking to you tonight on a Dell desktop. How did Dell get to be Dell like it is today? Well, in the 1990s and the early 2000s, they developed a just-in-time inventory system. Saved them hundreds of millions of dollars. They just produced their products when they were ordered. They didn't have them sitting on the shelves at Costco, or not many of them. They didn't have them sitting on shelves waiting to be sold. They only, and where you spend money to get them on the shelves, they spent the money when they knew the product was sold. So they just kept enough inventory to maintain those daily sales or over-the-counter sales. But most, if any of you bought a Dell computer, you order it, right? You order it, then they deliver it to you. But they deliver it to you after you place the order and after they build it. And they're so efficient in their distribution systems that they can get away with that. It's the same thing why Walmart became Walmart. They developed the technology of their distribution systems to only get the inventory to their stores when they were in demand. They didn't over distribute the product. They just had enough to get to the stores because they knew how much they were going to sell the next day based on their consumer buyers' habits. If any of you ever worked in a Target or a Walmart or a Costco, they fill their shelves at night when everybody's sleeping based on the buying habits and the availability of the product to put on those shelves because they know they will sell. I go to a Costco in San Dimas, and they're no fools. They know Rick Hassey comes in our lot. Why? I got a damn Costco card. So they know every time I walk into that friggin' place, oh, Rick Hassey's here. And what do we do for that? Let's put all the latest technology of flat screen TVs right up in front. Because Rick always walks in and he buys another friggin' TV every time he goes in there. When I go in with my wife, she puts a blindfold over me and walks me in by my hand so I don't see them, and we go to the back of the store where we can buy what we want to buy. She doesn't have me look at the technology up front. Computers, flat screen TVs, barbecues. No. Because when Rick goes into Costco, he walks out with one of those suckers. That's why they do it. They're not stupid. They know Rick Hassey. And they know most of us dudes out there. We go to Costco, $300 for a 50-inch? Wow, I'm taking this home because I'm watching football Sunday.
And then they sell caskets at the end.
Yeah, then they sell divorce agreements and tell you where to go for a lawyer.
Caskets and garage doors at the very end.
That's right, because most of my flat screen TVs ends up in the garage where I can watch it, or in the man cave because my wife says, no, you're not. No, get this out of here. You bought it. I want it out. You're right. So that's why I'm surprised Costco doesn't have a link to a law firm for divorce agreements, because that's what happens when you buy all this stuff. All right. But that's inventory management. We see it every day on TV. You walk into Vons or Albertsons. What's in front of the store? Soft drinks, potato chips, beer. Oh, Rick Hassey's here. He always walks in and gets a 6-pack. Okay, there he is. All right, that's sold. Oh, Rick Hassey's here. He's going to need some chips to go with that beer. All right, we got that out of the way. Inventory is down because we know Rick Hassey's coming. They know their buyers. That's why they're not stupid. They're marketing majors. They get MBAs in marketing. They know their clientele. They're not stupid. That's inventory management. For some reason here, collections and receivables are not cool. That's a problem. Accounts payable. When you borrow and use accounts payable, that means you don't have to write a check, right? Notice accounts payable here have increased. Accruals have increased. We borrowed more money. So what did we use with accounts payable? We ordered some supplies from Office Depot. We'll pay you later. Invoices. So at the end of December, I got the supplies. Hey, did I write a check? No. So I acquired an asset or something, and I owe the money, but in that particular time period, that's positive cash flow. Now, eventually in the next year, 2020, I got to pay that bill, so cash will go out. But now cash came in because I purchased something with that short-term debt and I didn't write a check for it. I owe the money. So that's an interesting concept of cash flow statement. If assets go up, negative cash flow. If liabilities go up, positive cash flow, because I'm not paying it out in cash. Net of all that, not very good. Negative $170,536 in operating cash flow. You got to at least break even to compete. They got to do something. Either they got to make more money or find solutions to their receivable and inventory situations. This is a bad thing. If I was at a stockholders meeting for this company, the first thing I would say to the managers of this company, what are you doing about cleaning up your negative operating cash flow? I want to know now, or I'm selling the stock tomorrow morning. Tell me, what's your strategy? What's going on? Most of them say this, because this is what they do at Laverne. I'm knocking them here. This is what they do. Well, we've hired a consultant, and they're going to come in and help us look at the situation. Why are you hiring a consultant that's going to cost double the amount of money? What the hell do your people do who you've already hired? Isn't that their job to manage receivables? Isn't that their job to manage inventory? Isn't it your job to do that? Why are you hiring? This drives me nuts about companies. And Laverne hires more consultants than anybody under the sun. Why are you paying these knuckleheads $300 an hour from Dewey, Cheatham, and Howell consulting firm to tell you what's going on, when you should be able to tell you that yourself? Now, granted, I might be getting some people mad at me here. Well, Mr. Hasse, I'm a consultant. Well, okay, but are you actually adding value to the company, or can they be spending these dollars elsewhere? I'm a consultant. A year and a half ago, a company hired me and said, Mr. Hasse, could you come in and look at our company? Well, I don't really have to do that. Why do you want to pay me? And my going rate was $300 an hour. Why do you want to pay me $300 an hour when I just look at your balance sheet and I say, your receivable collection sucks. It takes you 45 days to collect a 30-day loan or invoice. And what the hell's with the high inventory when you're not selling it? You want to pay me $300? I just did it. You want to pay me $300? Why don't you ask your receivable distribution manager about that? Why don't you ask your marketing and salespeople? Why aren't you selling inventory? Why don't you ask your treasurer and your controller, why aren't you collecting the money? Why don't you ask your sales teams who you're doing business with? Now, if you want to pay me $300 an hour, I'll come into your offices and sit for 6 hours, and I'll be gladly to take that check. But really, do you really need to do that? You know why? I've used that philosophy all my life, and I end up making more money because they go, oh my God, he's so honest. Let's hire him anyways. It works. It's so, why? He's so honest with us. I think eventually we're going to hire him anyways, because if he's that honest, all right. Well, then they bite the bullet, because then I'm so honest. I tell them, excuse me, ladies, I'm going to say something off color. I tell them that they're a bunch of assholes and they don't know what the hell they're doing. Well, you don't have to be that honest. Don't be that honest with us. Yeah, but if I was a stockholder of this company, I knowing what I do, I'd get the hell out of here. All right, enough of that.
Professor
Yes.
Hasse, can you give us an example of how you would buy something without giving when you buy something, you give them cash and then you get whatever you bought and the transaction. But like as a company, I mean, what would a company buy that they don't pay for 40 days or for 30 days or?
Well, let's look at an example.
Or on
That's
the flip
used.
side, what would you sell? And if I'm selling something to
Exactly.
you,
Let's look at an example that has been used in every MBA marketing class since the beginning of 1960. All right. in 1950s, a gentleman in Arkansas started Walmart, and for the life of me, I can't remember his name. Oh, Sam Walton. Sam Walton started Walmart as a little ditzy little local yokel retail store. But Sam had an interesting idea. How can I sell more products at a cheaper cost? I need to have more of those products and distribute them quickly to my stores at a cheaper cost. Then I can undercut my competitors because it's costing me less for those products. So Sam Walton said, okay, how can I do that? So he went to his vendors, his accounts payable people, the vendors, who he buys the clothes, the soccer balls, the beer, the wine, anything he puts in his stores. And he says, hey, dudes, I'm going to order from you in the next year 1 million units of this soccer ball. And I'll pay you the going rate of 50 cents a soccer ball. But here's this, dude. If you want me to order 1 million soccer balls, I want 50 days to pay your bill. Instead of 30 days, I'm going to pay you in 50 days. And most of them said, no worries, Sam. You got 50 days. So now Sam gets 1 million soccer balls and 1 million beer cans and 1 million whatever at that price. And then what does he do? He gets a distribution system and distributes those soccer balls and products immediately to his stores and sells them for 60 cents or 65 cents. But here's the key, Preston. He sells them immediately. He collects the cash before he has to pay the bill.
And sits on it. Or
and there you go. And then he takes that cash and does something else.
Mm-hmm.
And by the time 50 days go by, he's probably turned over that inventory a couple of times. Mm-hmm. And that's why Walmart was able to sell out all the mom and pop businesses in competition, because they could undercut the cost because he was buying massive. But the order for him to buy massive, he had to get deals from his vendors saying, okay, you're going to buy 1 million from me? Okay, you got 50 days. And that's how Walmart got to be Walmart.
I see.
Makes sense?
Makes sense now. Totally get it.
And so Target copied it. Costco copied it. They all copied it with little variances. Costco, you buy in bulk, but then Walmart came up with Sam Club. But that's how it all started. And every MBA marketing class I know of uses that as an example of distribution, supply chain management, marketing. Oh, it's brilliant. And that's how Walmart became the largest retail company in the world, by doing that and cleaning everybody out. Amazon does the exact same thing, using the cloud, using technology. They don't have to produce massive advertising expenses. You just click on Amazon, and here's the sucker thing. You pay $200 a year just for the glory of being Amazon Prime member. They got your $200 up front, and now you can get deals and get it delivered by Friday if you order tonight. It's amazing. That's how you compete. And that's why you're getting an MBA degree, to come up with those strategies, those interpretations, so you can take that thinking to your career. That's where they're going to that's when they're going to pay you the big bucks to come up with that stuff. Okay. I'm taking too long. Let's finish this and then we'll take a little break. So look at the financing section. Where do we get financing? Either issuing of debt or the issuing of stock and the paying of our stock in dividends to our shareholders. Well, look at the financial statement. Look at this year, they paid off huge amounts of the debt, the interest-bearing debt. Excuse me. They increased and got some more cash in by issuing 150,000 more shares of stock. How much money did they get? $1,220,000. So that's cash coming in. And as you can see, cash coming in, common stock is increasing, cash going out, debts are decreasing, and we paid out dividends. Net effect, we made 245,000 of additional cash flow by what's net after we took in that money for stock. So basically, they issued stock to pay back old debt, dividends, and cover the you know what of the operating deficit. But here's the kicker, as you'll find out soon in other classes. Issuing stock is the most expensive form of capital fundraising. It's very expensive. Why? The capital asset pricing model. When you issue stock, that's the expected return investors want to make in the next year. And if you have bad risk, bad beta, bad credit rating, that return is going to be awfully high, and that's going to drain your company to keep up with that. So you're issuing the most expensive form of capital, and the demand for that capital is the greatest in return. Not good. But the reason they did that is because they were too leveraged. As we see in the financial analysis, in 2018, they were 81% in debt, their debt ratio. In 2019, by paying off that debt, they got down even below the industry mediums. So they were too leveraged. So one quick solution is to issue some stock to reduce that debt. But at the same time, in the long run, they're hurting the company because most stock issued is to fund new growth, fund fixed assets, fund new markets. Why do companies issue IPOs, stock in the market? Because they're using that capital to pay off the old Shark Tank private investors, but also to increase assets to compete in the market and go with this business model to new markets and grow even more. That's why they issue IPOs. That's why companies issue second issues of stock. They need the capital to invest in new assets, not pay off old debt. Good Lord.
So they're paying credit cards with credit cards.
Exactly. In some respects. They're actually paying credit cards with the future. That's even more. It's like, oh, I'm out of work, so I'll just pull everything on the credit card. And why you do that? Because, well, eventually I'm going to get back to work. Eventually I'm going to make, and then what happens after a year, 2 years? Uh-oh, I'm not going back to work and I'm maxed out of my credit cards. What do I do now? That's what's going to happen to this company. Short-term fix, long-term problem. Just ask Radio Shack about that, baby. They did the same thing. Okay. And then finally, investing. Where are they putting their money outside of the company? Short-term investments, which are here, like money market funds or whatever, to earn some interest income or whatever. And then investing in fixed assets, right here, gross fixed assets. Went up $17,000. Wow. The net fixed assets decreased because why? Accumulated depreciation. But they only invested $17,000 in new assets. You're not going to have much growth there. So this cash flow statement tells us a picture of efficiency, inefficiency, where the money's coming from, where the money's going. Next week, we're going to talk about this next tab, free cash flow. This is what Warren Buffett really uses, but we'll talk about that next week when we get into our next topic of capital budgeting and capital structure. So that's for next week. But this week, financials, there's a little review, cash flow statement, and now we get into this. And now I'm going to bring this up to show you, and then when we come back from break, we'll take a look at it. If I go into my week 3, oops, not here, hang on. I got it, just a sec. I'm going to get this up so you can look at it while I'm gone, when we're on our break. There it is.
Professor Hasse, this may be kind of a dumb question, but when you're issuing more stock, the people who are buying that stock, they're owning part of the company, correct?
Correct.
Okay, so are you splitting if I'm a company and I make $100 and I have 100 shareholders, do we all get $1?
You don't have to. Remember, the company can distribute dividends at their management recommendation. Some companies don't pay dividends. Other companies pay dividends because they know if they don't, their shareholders will bolt. But if I have a good product, Tesla doesn't pay many dividends, but you don't see too many investors bolting. Why? Because they like the product, they like the future.
I see.
But other companies like Ford Motor Company have to pay a dividend or they're going to lose their shareholders. Depends on the culture of the company. When Steve Jobs ran Apple Computer for years, he told the shareholders, you're not getting anything out of me. I don't even care you own the stock. You're not getting any dividends. I'm reinvesting all the products, all the profits into iPhone, into Apple TV, into iWatch. And then Steve Jobs died. And the first thing they did at the first stockholder meeting after Steve Jobs died to Tim Cook, the new manager of Apple, is, okay, Tim, up with the dinero. It's time to start paying dividends. And Apple started paying dividends. Or the shareholders would have been, that's what back in the day when there were a lot of people out there wanting to take over Apple. And so Apple said, no, we don't want those dudes running our show. We'll pay you dividends as long as you don't sell to that guy. Okay.
What's the correlation between like how many stocks you issue and how many the company totally has as an entire company?
Well, remember, when you incorporate a company, by your incorporation, you're given a maximum amount of shares that you can issue in incorporation. For example, I start a business and I incorporate as a corporation. In the incorporation guidelines, now this is reviewed by lawyers, the SEC, Security Exchange Commission, and all of them. It says, Rick, now for the history of your company, you can issue 10 million shares of stock. All right. Well, I know I can't issue 10 million shares of stock in one issue. I'm not going to get much money for it. My company is still getting its name known. But I decide to issue, I do an IPO and I issue 1 million shares of stock. So 1 million shares of stock go into the market and they paid the nice price. They now are stockholders. I now have 1 million investors that I have to keep track of and make sure they're happy. Now, down the road, I'm growing. I need more capital. I don't want to borrow from a bank and have them looking up my skirt all day because banks do that and they drive you nuts. Excuse the expression. But then I'm going to issue more stock. So I can issue up to 10 million shares of stock over the life of my company. That's how that works.
Now, is 10 million shares of stocks 100% of the company, or is 10 million?
No, 1 million shares of stock is 100% of the company. Now, if I keep growing that share of ownership increases. There's not 10 million shareholders. There's just 1 million shareholders, right? I can have up to 10 million shareholders, and when it hits 10 million, that's 100% of the company. But in the time being, the 1 million shareholders is 100% of the company.
Okay.
For example, Facebook. 10 years ago, Facebook went public, IPO. Mark Zuckerberg said, okay, market, I'm going to issue 1 million shares. I don't know the exact amount, but this is approximately. I'm going to issue 1 million shares, but there's going to be 2 million shares outstanding. I'm going to own the other million. I'm going to own 50% of the company, you dudes. So that's what Mark Zuckerberg said. He says, okay, I'm going to issue 2 million shares, but I'm keeping 1.
Yeah.
You guys fight over the other million. So 50% of the company is now owned by me, which it still is. It's really 50.9%. So he's a majority stockholder. And the other shares are owned by the market. Now, when he issues more shares, he's going to make sure that he maintains that percentage and he'll just issue more shares to himself. And he can do that because he walks on water in that company. He can do anything he wants. He's got the board wrapped around his finger.
Okay.
See how that works?
So as long as he doesn't sell over 51% of the company, he always maintains whatever he wants to do.
Yeah, exactly. And down the road, maybe in 20 years, some new Amazon will come along and say, Mark, you're getting ready to retire. How about I give you $50 billion? No, that's a bad one. How about I give you $1 trillion for your company? And Mark gets 50.9% of that $1 trillion.
Okay.
If he only had a daughter, I'd be happy.
Okay, I get it. Thank you very much. That helped out a lot.
Okay, thanks. Okay, where was it? Oh yeah, I was looking up that stock. Sorry, bad examples. I apologize. All right, here we go. There we go. Finally. Good God. I got so many files here. Everybody see this financial statement analysis? Brianna, you see that? Thank you. All right, this is taken right out of our textbook. And this is in week 3 in-class review. We're going to talk about this after our break. And this is what we're going to talk about. It's on page 2. This is taken right out of the chapter. And it's all the financial analytical ratios of a company, broken down by profitability, asset management, liquidity, and debt management. This is what I'm going to be referring to, and this is what you're going to be using in your case number 1 in your financial statement analysis. Some of you probably have a history of working with this, others don't, but this is the information we're going to do on that. So we'll talk about that when we come back from break. So let's take, oh, Jesus, God, we're going to go late tonight. 7:30, the Dodgers won by 2 touchdowns, so that's done. And why don't we come back in 10 minutes? 7:40, we'll take over control of our corporate finance network at 7:40. I'll see you all then. And I'll put on some music. San Francisco, California, 1987, The Grateful Dead. Touch of Grey, another classic. I'm dating myself by this music, aren't I? Okay. Here's assignment case number 1. Let's read it, shall we? This work is due on Tuesday, October 20th at 11 p.m. posted to Blackboard. Please post your work file to the Blackboard site. You can post a Word file, a PDF file, an Excel spreadsheet, a numbers spreadsheet, however you see fit. This is your option here. In future case studies, I will give you the format you need to do. This one, you make the determination what you need to best answer these case issues. You have 6 companies to choose from. I don't care which one you choose. Home Depot, Lowe's, Caterpillar, Deere, Delta, Southwest. You pick one. Your first task is to do a financial statement analysis in 2 methods. Present a high-level financial statement analysis that identifies one key financial statement account that bears future or further investigation and ratio analysis. You don't have to do the analysis, just tell me something in those financial statements that piqued your interest. Could have been a cash flow amount, like we looked at earlier. Could have been they've lost money, their debt position changed, something that stood out by looking at their financial statements. Balance sheet, income statement, cash flow statement, something that you noticed. You don't have to do the analysis, just something. See, it says at this stage, no analytical presentation is required. Simply identification of the material and the significant account and why you believe it's so. The second level, the second analysis, is to identify ratios from each class of financial statement analysis, going back 3 fiscal years. And that's why I refer you to this. These are the 4 classes of financial statement analysis. You pick one from each one of these sections: profitability, asset management, liquidity, debt management. Pick one. Most of us, we usually pick profit margin on sales. Most of us usually pick inventory, if it's a retail company, inventory, which these companies do sell product, or days sales outstanding, something of their receivable analysis, asset turnover, one of those. Most people pick the current ratio in liquidity, and most people pick the debt to assets ratio, debt management, or you can pick any one of these, but one from each area, and you go back through excuse me, and do a 3-year analysis of this. The student will identify which ratios, not all the ratios, all you have to do is pick one from each of those ratio classes: liquidity, profitability, debt management. What was the other one? Did I say profitability? Well, one of those 4. One from each area. The financial statements are the source of your analysis. Now, if you use D&B Hoovers, a lot of those numbers are already given to you. You don't even have to calculate them. Or you go to the company's website, or you go to the company's 10K financial statement. All those are given to you in those analyses. You don't have to calculate anything. You just got to look them up. But I needed a 3-year analysis. You can provide industry standards if you want, but that's not necessary. Finally, within each class, a conclusion on overall financial performance will be presented. Based on your review of these 4 areas, what does it tell you about the company? What is that trend? What is it telling you? Then you will present an overall conclusion based on the financial presentation that you did on the relative strengths of this company. And would you recommend to buy or sell or own the stock? Finally, the based solely on the financial performance of the company, you don't nothing about the management team and if there's any scandal or whatever. As presented in your ratio analysis, the student will recommend to sell, hold, or buy the stock in the company. Excuse me. Excuse me. The second section of this analysis is to do what I was just talking about earlier, a risk evaluation. For the company you selected, prepare a risk analysis. Credit rating, beta, capital asset pricing model, required return on investment. Make that calculation for this company based on its beta. And I give you the risk-free rate as 0.7%, and I give you the market risk return of 8%. You do the rest. You don't have to look those up. I give those to you. Do a risk evaluation of this company based on that analysis. The following outline is simply an example of how the case could be organized and presented. You don't have to do it this way. This is me giving you this information to help you. Introduction and brief history of the company. Financial statement, balance sheet, and income statement, key account identification. Ratio analysis, conclusion, risk evaluation. In other words, you're doing what every financial manager with every company does every day. Take a look at the competition, take a look at yourself, and find what are the strengths or weaknesses, overall big picture, and looking at individual specifics by ratio class over a trending period of 3 years. And then coming to some conclusion, interpretation, and then doing a risk evaluation of their company's risk Expected rate of return by the capital asset pricing model. Remember, we talked about that earlier. The higher the percentage, the greater the risk. Put all that together. Would you own this company stock? Would you buy it? Would you sell it if you already owned it? Would you hang on to it? What does all this data tell you? And there's no template for that. I'm looking for your personal way of interpreting this information. Put that all into a paper or spreadsheet, however you want to do it, and give it to me in a week's time. And as I said earlier, if you need extra time, because this is for a lot of us who don't do this on a regular basis, this is some technical stuff here. If you need extra time, no problem. Just send me a little email, Mr. Hassey, can I post this next Thursday, next Friday, instead of Tuesday? No problem. That's why I have this lag time. There's no work to be done next week. You have some time to do this, but this is key for what we're going to be doing in subsequent cases. This is giving the basis of an understanding what happened, what is the trends, what type of company is this? Are they successful? Do they have potential problems? Are they risky? What's going on? Now with the pandemic, it's not going to be much of an influence because you're going back 3 fiscal years. So for some of these companies, fiscal year was December 31st, 2019, pre-pandemic. So you don't have to worry about that. Airline industry took it in the shorts this year, but that's after the pandemic. This might not be included. Same with Caterpillar and Deere. They kind of took it in the shorts. Home Depot and Lowe's have been doing very well. But that's pandemic. This is before that. Just pick one. You don't have to pick two and do a comparison. Pick one and base your analysis on this. If you want to send me a draft or an outline of how you are planning on tackling this, go ahead and I'll give you my recommendation whether you're on the right track or not. Go ahead and send me a draft. Go ahead and send me some information. I will say, Preston, keep on trucking. You got the right idea. David, might want to take a look at it this way or this way. Try it that way. You're more than welcome to send me a draft, send me information about what you're thinking, and I'll let you know if you're on the right path. I don't have a problem with that whatsoever. If you're using other sources besides the material provided by this class, if you have to go to D&B Hoovers, if you go to the company's website, if you go to their SEC 10K, you got to put that down as reference sources in your document at the end of your work. If you interview somebody, not me, but if you interview a homeboy, if you interview a former professor, if you interview somebody at your work, you have to include that information in a reference section at the end of the document. The only references you don't have to do is if you ask me for questions or approval, or you use your textbook or the materials provided in Blackboard. After that, you have to tell me where your sources of information were. You might want to think about this. Get a day or two to look it over, take it all in. And if something looks funny, something doesn't look right, something is confusing you, send me an email. I'll explain it to you. But don't wait to do this while watching Monday Night Football next Monday night. You don't have enough time. This is about a 5-hour piece of work. Thanks, Mr. Hassey. Appreciate that. This is about a 5-hour piece of work to do it properly. MBA. Yes. Every MBA in the history of mankind has done this work. Now it's your turn. Take a look at a company, look at a big picture review, do some specific review of their key ratios that you have selected, not somebody else, you pick them, and take a look at their risk evaluation. Sum it all up. What does it tell you about the company in regards to an equity purchase, buy, sell, or hold? If this was your competitor, if Lowe's or Home Depot or Deere was your competitor, what would it tell you about them as a competitor? If you were a manager of these companies, what would it tell you about yourself? If you were a potential investor, what would it tell you? You pick that interpretation and go with it. That's your choice on how to go about that. Part of the assessment on this is for me to see you think with the data, because the type of areas you could go on this are endless. You don't have to be that fancy in the presentation. Type it up in a Word document. You don't have to use APA format. You don't have to do any of that stuff. You just put it together however you think is professional and explains what you're trying to do. Don't get all bogged down in the format. I don't care. I care about your interpretation and what data you use to get that interpretation. That's the key. We've already gone over this tonight. This should be a no-brainer. It's finding this data and going with it. This is what you're going to spend some time on. But remember, put it in a format that me as the reader looks at it and says, all right, I know what Katerina's making sense here. I know what she's trying to say. This is a good presentation. I can understand what she's doing, what's her analysis, what's her interpretation. Make sure you reads to you as you finish it up, because that's the key to me giving you a grade. So take a couple days to look it over. If you have questions, let me know. Or if you get right into it, let me know too and send me a draft. I'll say, Carlos, you're excellent. You're on the right track. Keep on trucking. Or Carlos, I don't understand. I can understand what your ratios are, but what are you interpreting from that information? What are you trying to get at? What's it tell you? I need to, where are you going with this? Okay, thanks, Mr. Hassey, for clearing that up. Now I know where to get to. So this can help if you have me take a look at it. But don't send it to me Tuesday at 9 o'clock when it's due at 11 o'clock. I have a class Tuesday night, so I won't be able to look it over. So probably on the weekend would be the best time to ask me any questions about your work, and then you can clean it up on Monday and Tuesday. And if you need extra time, you need extra time. It won't affect your grade whatsoever. So don't worry about that. Need a couple extra days? I'd rather you do it correctly and professionally. That's the key.
Mr. Hassey?
Yes, sir.
Got a quick question.
Yes.
I think I kind of wrapped my mind around everything else, but the very first portion of this, the high-level financial statement.
Yes.
Can you just clarify?
Yeah. Here's what's something. Let's say you pick Delta Airlines. All right. And you look at their financial statements and you see that over the last couple of years or 3 years, Delta made a lot of money 3 years ago, and all of a sudden now they're not making any money. That's a big financial statement review by saying, okay, where it says here, present a high-level financial statement analysis that identifies one key financial statement account. All right, the account you're looking at is income statement. You're looking at the profit, the bottom line. And boy, there's a big change over the last 3 years in Delta. That's all you have to say. Okay. Now you got to show me the statements. You should have an addendum or an exhibit file where you show all the statements and you refer to that. See, Mr. Hassey, notice their net income over 3 years. That's a problem. You don't have to do any more analysis after that. You're just pointing out something from the financials that you identified with as a potential further investigation or further analysis. But you don't have to do that analysis. Just pick it out. Does that make sense, Charles? Or you could go to the cash flow statement for the last 3 years and see that over the last 3 years, they've been gradually decreasing in the amount of cash that they're producing, cash flow in the company. It's been dropping. All right, that's a great point. You don't have to do anything more after that. That's all you have to say. All right. Now you go on and go and pick 4 ratios or 4 analysis from those 4 classes. And then now you get in a little deeper looking at those 4 individual things. And maybe that might tell you some more in relationship to it might not in relationship to this, or it might not. But I want you to do a macro view and then take a look at the more micro view. Does that make sense, Charles?
It does. So the middle part doesn't necessarily have to justify the assumption.
No, it doesn't have to justify it at all. And you might say, geez, I saw that their cash flow has gone down the last 3 years, but in this review of this material, I see nothing in this data that tells me why. That's okay. But my conclusion is based on their cash flow dropping in the big view and then this additional analysis here, I wouldn't, I wouldn't recommend to buy this stock right now based on this explanation. Make sense? Does that help?
Yes, sir.
Okay, so that's what I want. So nothing fancy up here, just pick one thing. Okay, I see this. All right, thank you. Now you go into a little bit detail and will you find a reason for that? Maybe, maybe not. With some of these companies you will, and some of these companies you won't, because I've already done this for all these suckers and I know them. And so
So,
it'd be interesting to see how you interpret it.
okay, Mr. Hassi, so about for the second part, I have to write the ratio for the 3 years for it, and compare each year between, So for the second part, sorry about that. The second part, I have to go in detail and write about the ratios, like pick
Right.
one ratio. Yeah. So I have to do it for the 3 years
Yes.
and compare between them.
Yeah, notice any trends, anything that sticks out to you by looking at the trends over the 3 years.
Okay.
Their debt position, you might do a debt ratio for debt management, the percentage of debt to assets.
For the 3 years. Okay.
Yeah, and you might see a lowering of the debt situation over time or an increasing of the debt situation over time. What does that tell you? Also in relationship to the other information you find. Okay?
Okay. Thank you.
Professor Hassie, is this going to kind of give us like a half answer though? Because if they're taking on, we might see, okay, they're taking on more debt, but maybe they're buying more things. Like, are we going to, at the end of this,
you should conclude that then.
That should be one of the other four then, basically.
Yeah.
Okay, that makes sense. Okay.
Trust me, the reason why I picked these companies, it all comes out in the wash. You might see one going something that leads into something else. You'll see that in your analysis.
Okay.
Okay.
Thank you very much.
Okay. And what you can do is you can show me your analysis, a rough outline, or when you do it, and I can just let you know. Yep, you're right on it. Go ahead, keep going. All right. You're more than welcome to show me that, and I will review it for you. Again,
Professor,
yeah.
What's the best source to find the industry average?
Dun & Bradstreet. Have I showed you guys Dun & Bradstreet Hoover's database yet?
No.
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 I feel why I don't understand this. You're in an MBA program and that you're at this level of study and nobody has shown you this in the history of your studies at Laverne. I don't understand some of these people around here. All right, I'm going to show it to you. Okay. I don't understand that. I'm gonna start bitching here. So sorry for the word, but this is ridiculous. You guys should know about this. All right, here we go. I'm gonna get out of this and watch what I'm gonna do. This is a good thing. I won't complain anymore. This is a good thing. I'm going to go to our dynamic University of Laverne website, and I say that facetiously. All right, here it is. Okay. For all the money they spend on this piece of crap, it's worthless. All right, there we go. Again, more political commentary you don't need to hear. All right. Here's the University of Laverne website. I'm an MBA student. I live in Point Mugu. I live in Santa Barbara. I live in Irvine. I live wherever. And Mr. Hassie has given me a son of a gun case study. The first of 4, and they get even better after this, I just might want to add. But that's future attractions. So Mr. Hassie has given you a case study and you're not near Laverne at all. So you go to academics, the pull down menu of academics, and go to the Wilson Library. And now you're in the Wilson Library. Yeah, see, you're hanging out with the guys, swapping stories, seeing what's going on. And in this, you go to databases at the Wilson Library, databases. Click on business. I'm recording. Am I recording this?
No. Oh.
Yes, I am.
Yes.
Whew. There's two people who couldn't be in the class tonight because they were both had family issues. So, whew, that's good. Okay, you go to business. And two things on this page are good. First of all, if you ever have any trouble, if you say, Mr. Hassey is giving me this idea for do some research and look things up, I don't have a clue what the hell's going on. Call up, email Linda Gordon. She is the College of Business librarian. Her job is to help you. That's her job. If Nezreen has a question or a problem, and I don't want to bother Mr. Hassey, but you still can bother Mr. Hassey, just know that. You can contact Miss Gordon. She can help you. But here's the database you want to use. It's called D&B Hoovers. Dun and Bradstreet Hoovers database. You click on that, and it's going to ask you to log in. They want to know that Charles is Charles, David is David. So you you type in your email address and your password for your email and hit sign in. And up it comes. It gives you some of these stupid little tips, and I always go through those. So now you up to search for a company. Now I'm not going to search for any companies that I have listed, so forget that. I'm not going to show you those. But let's say we're doing a financial statement analysis of my old friend Ford Motor Company. Type in Ford, and right at the top of the list, Ford Motor Company, Dearborn, Michigan. You click on that. Everything you always wanted to know about Ford, but were afraid to ask. Any company, and all those 6 are in this listing, so you don't have to worry about that. There's even a map how to get to their headquarters if you're so inclined. But you scale down here and look at right here, financials, income statements, balance sheets, cash flows. You want the annual statements because you're concerned about fiscal years. So you click on annual statement, and up comes 3 years of income statement, 3 years of earnings per share. And here's the cool thing about this. You can click on this and download it into a spreadsheet. You can click on this and print it out. I downloaded to a spreadsheet. Now you got 3 years, and now you can use that as an analysis. You also can go to the balance sheet. 3 years of the balance sheet. 3 years of the numbers of Home Depot, John Deere, Delta Airlines, all will be right in front of you that you can download into a workable spreadsheet to do your work. This is where you get this information. Nice and neat and clean. And the good thing about it is you're a student. Nobody else has access to this information. Now I go back to company summary. Tells you about the company, tells you about the key players, latest news. Oh, wow. Look at that. Financial summary, key ratios, view financial health report. Oh, it's stuck. Son of a pup. Well, you can get all this information. Now, this is the latest financial ratios, but you can get this information, and it's included all through these. Your job is to find it. But the financial ratios are here. Now, I showed you where the financial statements, and knowing that page 120 that I gave included with you with the calculations, you can calculate those financials based on those formulas given. But there is a section in here where this information is already done for you. And you don't even have to calculate it. All that information is ready for you to grab. It's somewhere in here. You got to find it. But I've given you a good start. Fair enough? You got to do a little research, for Pete's sakes.
And then we would just reference this this site.
Yep.
DNB Hoovers. Okay.
Yeah, that's exactly right. But here you have your statements that you can print out, download, and work from. All kinds of data. This is a cool thing. For example, no, I'm not going to show you anymore. You guys got to figure this out for yourself. You're good here. But I'm telling you, in any class of doing any research about company performance, supply chain management, credit ratings, all that jazz, right here. Now, if you want to get a quick and dirty beta of your company, just go to Yahoo Finance and you can find that rather quickly. All right, for that risk evaluation. The thing you got to find there is the credit rating, the D&B rating, AAA, AA, whatever. You can find that. That's located also in this information, but I won't show you where that is. And you get the beta. You can go get quickly the beta. You can do the second question on risk evaluation in about 10 minutes. All you have to do is find the beta and the credit rating, and you're done. You can get that credit beta right off the Yahoo Finance very quickly. There's no trend analysis in risk evaluation. You're just taking a snapshot as of today of the risk. Does this help? This is a good source of information. Okay, I'm going to stop here. I'm going to leave this up in case anybody has any questions, but I'm going to go back to this. Here is where all those formulas are. You got to pick one from each one of these. You pick, and it gives you the formula. So if you have the financials and you can't find, well, I don't understand, where is this? Well, you just get the net income and divide by the sales from the income statement. You just get the total sales and divide by the assets to get that. Current assets divided by current liabilities. Total debt divided, or whatever. There's the equations there. That's why I provided this information for you. Because some of you I know don't have the textbook. Okay, a lot to chew on, granted. But I wanted to give you guys a good entrance into corporate finance MBA study, and this is the ticket to start. Can you interpret and research data and tell me, in your opinion, what you think about all this? I want to see how you do on this. Case number 2 is going to be all spreadsheet. Case number 3 is going to be all in PowerPoint. We'll explain that as we get to those various segments. But in each one of these cases, you're looking and interpreting at strategy, data, conclusions, and commenting in your own way what you think is going on here. What does it tell you? The key thing is to give me your interpretation. I might disagree with it, but if you give it to me in a clear, concise manner, you're going to get an A. Trust me. Even though I don't agree with you, if you put it together right, in a right way, you're going to get an A. Now, if I disagree with you and you put it in a way that I don't know what the hell you're talking about, you're not going to get an A. So don't worry about saying, oh, Mr. Hasse, he's probably going to agree with this. He's probably going to say this. You should not think of that whatsoever. Many of you are smarter than I am. You'll interpret it. I want to hear how you interpret it. That's and how you present it. That's where you get your A. Any Joe Blow can go up and look this data up, but no Joe Blow, not in my class, has to be able to say what it tells you. That's what I'm looking for. Excellent. And again, as you get into this and you say, holy crap, I'm going to need some more time to figure this all out. Take it. You do not have to be constrained by the Tuesday 11 p.m. deadline. Take as much time as you need, please. Do not worry about that. Just let me know what you're doing. That's all I care about. Fair enough? Last chance for questions on this topic. Katerina, you've been awfully quiet tonight. Anything? Everything okay?
Yes, can you hear me?
I can.
Yes, I'm good. I'm good right now.
Okay, cool.
Thank you.
You know, somebody I haven't heard from tonight is Mr. Patel. Where is he? Mr. Patel, what's going on with you tonight?
I'm here. I think I'm getting a cold, so hoping it's
All right, wait a
nothing more
minute.
serious.
Where's my mask? I got to put on my mask. You think you're getting
I
a
know.
cold?
I know, right?
I wish you would have told me. I would have put on my mask. I hope
I'm
you're
gonna go
feeling
get the good old COVID test tomorrow, so
feel better, please.
appreciate it.
Okay. Walt, are you drinking a beer? Did I just see a bottle of beer?
No, it's root beer. I
Oh, yeah,
swear.
sure. That's what they all say. Okay. All right. So as you go through this over the next couple days or into the weekend, something's bothering you and something doesn't feel right, send me an email. Send me a text. Mr. Hassey, I'm really clueless. Can we have a Zoom meeting? No problemo. We'll have a Zoom meeting. All right. Let me know. My job is to make sure to guide you through this new territory. And this is a good start. Because remember what I said the first week of our class, the key to this class is to get you thinking. How to think and present data that tells us your opinion, your interpretation. Because people are going to pay you a lot of money if you do that well. Trust me, I know. But don't be a consultant. You don't want to do that. I'm teasing. I get myself in trouble by knocking. I'm a consultant, so I'm knocking myself, I guess. All right, so there's the data within Blackboard. Let me just go back through this again. So there's the case and the instructions that we just showed you in case study number 1. In week 3, that's tonight, here's that spreadsheet we talked about tonight. Financial statement review. Here's those financial statement 4 key areas that you have to pick from. Last week in week 2, we had this spreadsheet that did the capital asset pricing model, which we saw a video and reviewed earlier. So I think you're in pretty good shape. Your job is to just wrap your arms around this and get at her. I've recorded this so you can always refer back to it over the weekend at our YouTube site or in our Zoom links where the links are to those class recordings. My office hours are Monday and Wednesdays from 3 to 5. But remember, you can contact me at any time, just not 3 to 5 if that doesn't fit into your schedule. So you got all the necessary data. You know where to research it and where to get it. You're off and running. And just think, where is this? Where is, oh, what does it say there? All right. If there's nothing else, I'm going to excuse you. Have a great rest of the week. Be well. Mr. Patel, get healthy. Get rid of that stupid cold. We don't want colds. That's a bad thing. So get healthy. And we'll see you all next Wednesday night, if not sooner, if you have any questions. Thanks, everybody.
Thank you.
Bye. Good night.
Bye, Nazreen. Bye,
Bye.
Katerina. See ya. Walt, you can now drink that beer. Forget the root beer.
Good night.
Good night. Good questions, Charles. Thank you. Those were good. Walt, this study should be right up your alley. Get into it. Okay. Take care.